Welcome to StockTok's deep dive into Chubb Ltd. Chubb is one of the world's largest publicly traded property and casualty insurers, underwriting commercial and personal lines across more than 50 countries. At the time of recording, the stock is trading at 330.83, sitting comfortably above both its 50-day moving average of 328.79 and its 200-day moving average of 297.02, which is a structurally constructive positioning. The 52-week range runs from 264.10 on the low end to 345.67 on the high. The RSI, the Relative Strength Index, a momentum gauge on a scale of 0 to 100, currently reads 55.1, which sits squarely in neutral territory. No technical extremes here. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Chubb Ltd generates revenue primarily by underwriting insurance and reinsurance risk across property, casualty, accident, health, and life lines, supplemented by investment income from a large fixed-income portfolio. Its competitive moat rests on underwriting discipline, global distribution scale, and a strong brand in the high-net-worth and specialty commercial segments, areas where pricing power is real and competition is more limited. The StockTok score comes in at 59 out of 100, signaling a hold. Valuation leads the scorecard at 17 out of 20. Financial health registers 9 out of 20. Profitability scores 11 out of 20. Growth earns 14 out of 20, and smart money rounds out at 8 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? Chubb's trailing price-to-earnings ratio, the stock price divided by the last 12 months of earnings, sits at 12.86 times. The forward price-to-earnings, based on next period estimates, is 12.32 times. For a global insurer of this quality, that is a relatively undemanding multiple. The PEG ratio, which divides the price-to-earnings by the expected earnings growth rate, with readings below 1 considered potentially attractive, comes in at 0.61. That is a notably low figure that suggests the market may not be fully pricing in the company's growth profile. EV/EBITDA, a capital structure neutral earnings multiple, is 11.01 times. In our view, the competitive moat here is durable. Chubb benefits from pricing power in specialty and high-net-worth lines, and possesses meaningful intangible assets in the form of its global underwriting expertise and client relationships. The Guru Focus value, an independent estimate of intrinsic worth, stands at 291.67 at the time of recording, implying a negative 13.43% margin of safety, meaning the stock is trading at a modest premium to that estimate. Wall Street analysts, at the time of recording, have a consensus mean target of 341 across 23 analysts, with a high target of 385. The next earnings report is due April 21st of 2026, with the street expecting earnings per share of approximately 6.60, and in our view, that represents a near-term catalyst worth monitoring. Among insurance peers, large diversified carriers have historically traded in a range of 10 to 15 times earnings, so Chubb's multiple is not stretched relative to sector norms. Market sentiment around Chubb, as of the creation of this video, leans neutral, with insufficient recent news flow to shift the needle in either direction. On balance, the valuation setup looks reasonably attractive to us, though the premium to Guru Focus value warrants discipline. Moving to financial strength, how solid is the foundation? The Piotrowski F-score, a 9-point checklist of profitability signals, leverage trends, and operating efficiency, comes in at 8 out of 9. That is an excellent reading. Anything above 7 is generally considered indicative of a financially robust business. Now, the Altman Z-score, a model originally designed to estimate bankruptcy risk using balance sheet ratios, reads 0.00. Before drawing an alarming conclusion, it is essential to flag that this model was developed for industrial companies and is structurally inapplicable to financial institutions like insurers, where reserve accounting and regulatory capital frameworks make the standard Z-score meaningless. Do not read distress into that number. Looking at the actual debt picture, the debt-to-equity ratio is 0.23, which is conservative. Interest coverage, the number of times operating earnings cover interest expense, is a strong 18.07 times. The cash-to-debt ratio is 0.13, which is modest, but again, insurers operate on float policyholder premiums rather than cash hoards, so this is consistent with the business model. In our view, the balance sheet is sound, and the Piotrowski score tells the more meaningful story here. Next up, profitability. Is this business actually making money efficiently? Let's start with return on invested capital, which measures how effectively the company converts invested capital into profit. Chubb's return on invested capital comes in at 4.49%. For an insurer, return on invested capital is less intuitive than for a manufacturer or retailer. The denominator includes substantial investment portfolios and policyholder reserves that inflate the capital base. So we'd want to look at this figure in the context of the broader insurance universe before drawing a hard conclusion. The gross margin and operating margin figures reported are zero, which reflects standard insurance accounting conventions. Insurers do not report gross profit in the way industrial companies do, so these fields are not meaningful here. Where the numbers do speak clearly is at the bottom line. Net margin, the percentage of revenue retained as net profit, is 17.17%. That is a healthy figure for a large insurer, reflecting disciplined underwriting and efficient claims management. Free cash flow margin, the percentage of revenue converting to free cash, is an even stronger 21.34%. That free cash flow generation is notable, as it funds both capital return and reserve strengthening. Return on equity, net income as a percentage of shareholders' equity, is 14.95%. Return on assets is 3.96%. Taken together, the profitability profile, in our view, reflects a well-managed, capital-efficient underwriting franchise. Onto growth. Is this business expanding, and at what rate? Over the trailing 3 years, Chubb has delivered revenue growth of 11.8%. Extend that window to 5 years, and the compound rate rises to 13.9%. For a company operating in what many consider a mature, cyclical industry, those are genuinely impressive figures. They reflect a combination of favorable pricing conditions in commercial lines, where hard market dynamics have allowed carriers to push through premium increases, and Chubb's deliberate expansion in emerging markets and specialty segments. Book value growth, the increase in net asset value per share, which is arguably the primary scorecard for an insurance company's long-term wealth creation, has compounded at 15.7% over the trailing 3 years. That is a strong number. It tells us that the company is not merely growing revenue, but is building durable equity value for shareholders over time. The dividend yield at the time of recording is 1.17%. While that is not an income investor's headline yield, the dividend has grown steadily and reflects management's confidence in sustained free cash flow. The data suggests a business that is compounding consistently, and in our view, the growth trajectory here is one of the more compelling aspects of the Chubb investment thesis. We would, however, flag that insurance growth rates are cyclically sensitive. A softening pricing environment or elevated catastrophe losses could pressure the top line in future periods. Now let's talk smart money. What institutional capital is actually doing with this name? 21 top-tier guru investors currently hold Chubb in their portfolios, which is a meaningful signal of conviction among sophisticated, long-horizon capital allocators. The most consequential holder on that list is Warren Buffett's Berkshire Hathaway, which holds Chubb at 3.9% of its portfolio and has been adding, most recently increasing the position by 9.31%. Buffett's presence here is not trivial. Berkshire built its reputation in part through insurance operations, so when Buffett takes a meaningful position in a competitor's stock, the market pays close attention. David Rolfe of Wedgwood Partners has the name as a fresh buy at 3.29% of his portfolio. Christopher Davis of Davis Advisors is also adding, having increased the position by 10.86%. These are value-oriented, long-duration managers, the kind of investors who do their homework. Now, flipping to the cautionary signals. Only 11.6% of 13F institutional filers, meaning investment managers who report their holdings to regulators, are net buyers of Chubb. A reading above 50% would suggest broad institutional momentum. 11.6% tells us the smart money is concentrated in conviction names rather than reflecting broad institutional enthusiasm. Insider ownership is low at 1.08%, and over the most recent 3-month window, insiders have recorded 0 buys against 8 sells. Insider selling is not always bearish. Executives diversify, exercise options, and meet tax obligations, but 0 buys in a 3-month window warrants note. On balance, the smart money picture is mixed. Elite conviction at the top, muted broad participation below. And finally, the verdict. Let's bring it all together. On valuation, in our view, Chubb trades at a reasonable multiple relative to its quality. A sub-13 times earnings profile with a PEG below 1 is not demanding, though the modest premium to Guru Focus value means the margin of safety is thin rather than wide. On financial strength, the Piotrowski score of 8 out of 9 and interest coverage of over 18 times are reassuring. The balance sheet appears sound for a regulated insurer. On profitability, the 17% net margin and over 21% free cash flow margin speak to a disciplined, well-run underwriting franchise. On growth, compounding revenue at nearly 14% over 5 years and book value at over 15% over 3 years is a genuinely differentiated track record in the sector. On smart money, Buffett's continued addition carries real weight, but the low insider ownership, 8 insider sells with 0 buys, and limited broad institutional buying momentum collectively warrant a measured stance. The overall StockTok score of 59 out of 100 reflects a business of high-quality trading at a fair but not deeply discounted price. The setup looks more like patient accumulation territory than a screaming entry point, in our view. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Chubb Ltd. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.